that, you don't grow in your comfort zone. And the reality is that wealth is made with calculated risk. We don't have the assurances, obviously, of anything, but you've got to be willing to take some calculated risk. And I think that right now, that is one of the most positive aspects of the market.
That was Jeannette Robinson. So she's the Investor Relations Director at Blue Lake Capital. Stay tuned as we have a really great conversation on what it looks like and the opportunities to invest in this current market. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast.
All right, partners, welcome again. I'm your host, Jake Wiley. And this week, as you heard in the intro, we're joined by Jeannette Robinson. So she's the Director of Investor Relations at Blue Lake Capital. Jeannette, welcome to the show.
Thanks so much, Jake. I appreciate you having me.
Yeah, this is going to be a great conversation because without a doubt, so we're recording this in February, the end of February of 2023. The markets are tumultuous, to say the least. You are the tip of the spear when it comes to investor relations at Blue Lake. So obviously you're probably getting a million questions and you're having to provide a million really good answers. And I can't wait to dive into that with you. But first, for my listeners out there that, one, don't know you, don't know Blue Lake, I'd love to give you an opportunity to tell a little bit about you and tell a little bit about Blue Lake.
Well, thanks. I definitely appreciate it. So I love Blue Lake Capital. Our CEO is Ellie Perlman. It's quite the story as to how I actually was connected with her, but I'm very thankful that I was. It happened many years ago. Back in the day, it was initially just myself and Ellie. And we were, a lean, mean startup at the time. So it's been really exciting to see the growth and the way that we've been able to scale out. I'm very grateful to our investors that have made that possible for us. Basically since inception, we've had about $750 million as far as assets that we've brought into the portfolio, over 3,300 units. Our net IRR to investors thus far is 30.9%. And, we're aiming to maintain or hopefully exceed that. The market obviously is much more challenging now than it was, 3 years ago, 4 years ago, 5 years ago. So, this is where we are today. But, as a nice broad stroke overview, that's what we do.
That's a great growth story, right? And you've had the fortune of kind of growing in a market where the tide was rising and things are changing. And I think what's nice about you guys at Blue Lake is you've had a little bit of experience under your belt. So, you've probably been getting ready for this. Let's maybe start the conversation on the direction of markets. So which markets are you guys in?
So we focus on the Sun Belt, primarily on the eastern half of the Sun Belt, Texas, Florida, Georgia, the Carolinas. Class B assets, value add. We have ambitions of doing other things, but it's not the time for that. And we really want to, as they say, stay our lane, know what we do well and just do that right.
Yeah, that's a great point. I see a lot of folks out there that have this shiny object syndrome where they're like, whoa, hey, maybe this isn't the best asset class right now. Let's pop over and do something else where we're seeing higher returns. And that's a little frightening to me. But, I guess taking it a step further, let's talk about real estate as a whole. What is your view? Like, I'm sure you've got investors coming to you and saying, like, what are we doing? Should we just sit on our hands? Like, what's your advice?
There's both reality and there's perception. So the reality is that real estate goes through cycles. It's not always, a party, if you will. It's not always easy. You don't always get to see, these tremendous types of rent increases and all of these other factors that have led to some really nice returns the last several years. The reality is that's not sustainable. And so real estate as an industry goes through cycles. And that's one component that I think is extremely important to remember. And the reality of that too is that, many people have been successful in making money and scaling their wealth across these various cycles. So that's, one perspective that I think is very important. What I would say is basically, if I'm looking at investor sentiment, I'm seeing kind of one extreme or the other. I'm either seeing, investors that are feeling nervous and want to kind of sit on the sidelines for a while and see if the market stabilizes and essentially are not investing right now. And the flip side of that is I'm seeing a lot of investors with the opposite opinion, where they believe that there's going to be a tremendous amount of opportunity coming available in the market. I confirm that we are absolutely seeing that in deal flow and anticipate seeing a lot more of that. And they're being very bullish. They're doubling down and taking advantage of the opportunities that these more challenging markets are presenting for operators, where essentially it's not necessarily that the assets are distressed, but the operators are. And that's a lot of opportunity to be had. So it's really a matter of perspective and really investors' appetite for risk. And most importantly, what I would say is their strategy, their long game. Why are they doing it in the first place?
I want to dig in a little bit on what you just said about, it's not the assets, but maybe the operators that are in distress, because I've been banging this drum and I'd love to hear how you explain what that means and how that works.
Well, so essentially right now, asset management is going to be one of the most critical factors for any operator to be successful. We're not pushing rents to the same rates that we were. Capital is not, cheap anymore. When you take into, consideration the interest rates and that impact on overall inflation, there's a lot of macroeconomic factors that are coming into play on this. There's a lot of ripple effects. So specifically, some of the examples that I can give you is I know, unfortunately, that there are some operators out there who did not choose to get a cap when they got their financing put in place. And without having, a rate cap in place, they are being pummeled by the feds continuing to rapidly and very highly rise the interest rates. And so it's not sustainable for them to hold on to those assets when their debt payments are literally quadrupling, from what they were initially. So that's an instance where the asset is not necessarily under distress, but the operator is. And unfortunately, we're beginning to see that. Or, there's also a similar situation, which is where cap rates are in place, but they are coming due. And fortunately, I'm seeing some operators are having to call capital or bringing in additional pref equity to cover the gaps. There's different circumstances like that are making it very challenging, but, also really creating a lot of opportunity.
Yeah, I think that's a great explanation. And maybe if I can just add on, because I think this is so important, is that there are great units. Let's just pick multifamily, right? That makes a lot of sense. They're still seeing rent increases, right? There's still pressure, housing pressure in markets, right? So if we think about markets, there's the macro, which is everything. And then there's the micro, which is like in the specific areas. There's still rent pressures. Like the rents may not fall through the floor. They may not even go down. They may go up a little bit. Like that's still possible. But when you have debt that's coming due, or, a model that was built off of a debt at 3% and it's now 6.5, whatever that number may be, all of a sudden the numbers don't work. And, operators are working on razor thin cash flow. And these things are very important. And when you have a debt term that comes due on a really great asset, it's performing, it's cash flowing, like the cash flow is not coming off. It's just basically the debt service is creating a lot of pinch there. And, what we're talking about here too is like bridge loans, right? So you've got small loans. They could have 3-year terms. They could have 5-year terms. They could have longer terms. And there's ways that you can put caps on how much the interest rate can go up over time. And recently those caps have been super expensive. But if you go back, let's just go back in time 2 years. Nobody saw this coming. Well, we kind of did, but like a lot of people didn't. So there's like, hey, look, I've been doing bridge loans for forever. And frankly, the interest rates have gotten better, right? Like we'll just keep rolling that way. And it didn't work. And now, that's coming due. So I think your point is right, is that there will be great assets that actually need very little or no repositioning that will just be an opportunity to grow in this space with something that's already performing. And it's just the existing operator has to move on from it.
Yeah, exactly. And kind of in everybody's defense, for lack of a better term, these deals wouldn't have penciled 2-3 years ago if we were projecting interest rates at what they are today. Had we actually underwritten deals like this with interest rates like this 2 or 3 years ago, people would have thought we were crazy, because no one ever suspected that they would rise so quickly and so high a few years ago. So yeah, you're 100% correct. And it's unfortunate, but it does create a lot of opportunity. And I think now that's really where the focus needs to be, which is what can we do with these opportunities that are being presented?
And that's really what I love about this show, is that we're focused on, yes, it might seem like it's doom and gloom in the marketplace, but there's always opportunities. And you probably heard me say, my listeners out there, that real wealth is built in downturns. Like that is the truth. And we're in a downturn. So real wealth is on the horizon, right? Not that just gradual appreciation and kind of general trends in the past 2 years have been nuts, right? Like that's unprecedented really across any space, unless you're investing in crypto and you're making 10x money or 100x or whatever. We're talking about real estate here, and it is cyclical. But when you buy right and you're buying at the right part of the cycle, which means that like It's got to come down. And then when it comes down, it goes back up. And that's where you want to be. Buy low, sell high. It sounds super easy, but it's hard, right? Because you have to have a plan and we've got to figure out how to get through that. So I kind of want to, take this to the next step. Is it, what does the future look like? How are you guys working with your investors and how are you guys strategizing through kind of this cycle so that you're not in the same situation as some of these operators that are having to hand over the keys?
Well, that's a really interesting question. So one thing I will add really quickly, because it's part of our strategy now, is, this is not just private equity. This is not just, smaller owners and operators. Institutionals are running into these same issues also. So we are seeing really nice institutional assets coming onto the market because even the institutionals are being pushed to provide liquidity for their investors. I wouldn't quite call it a fire sale, but we're definitely seeing assets coming online that are absolutely wonderful quality assets, but they've got to move and they can't hold off much longer as far as selling the asset and doing what they need to do for their investors. So what we are doing right now is kind of a handful of things. So first and foremost, definitely only sticking to fixed rates for sure when it comes to our debt. This is just not a variable we want to have to deal with. We would rather, have confidence that we have a fixed term, which makes our projections just a little bit obviously more reliable. So that's one thing that we're definitely implementing. And thankfully we did already on the last deal that we closed. Another thing is you've really got to monitor expenses. You've got to really make sure that you're optimizing your assets and you want to make sure that they're being managed very efficiently. So it's not only, really monitoring expenses and being very cautious with that, but it's also being creative and creating additional revenue streams within the asset also and pushing income in that way instead of solely relying on rent increases because they're not going to be, as significant as they were before. So that's another component. And the third, without hopefully not giving away too much, is essentially exactly to your point, Jake. If you buy right now, it's a very good time to buy because institutionals will absolutely come back into the game from a buyer standpoint rather than a seller standpoint in due time. I don't think it'll be right away, but I definitely think it will come back to us and to be able to pick up some really nice assets right now in a downturn and wait for the market to ride out a little bit and then be able to turn those units, when things pick up. Going to be a very good opportunity.
I think that's a really interesting point, especially on the institutional front, because you're exactly right. As I was in a conversation not too long ago with some institutional players, we keep the names out of it, but they're working in these open-ended funds where theoretically investors can kind of come and go. And if you've been watching the headlines, you've seen that like some of the larger REITs and players are out there are having to limit investor redemptions, meaning how much they can pull back out, and it's being gated. And, we've had a couple of these conversations, and what was really interesting about it is that some of these larger institutional investors, and I'm not talking about the owners and the headline names, the people behind it, right? The ones that are actually writing the check, they have their own portfolio, right? So they're trying to balance their portfolio. But what's interesting about what they're doing is that they are looking at their portfolio and saying, hey, we've got money in like this institutional player, this one over here. And what we'd like to do is pull some of it out for those that are actually performing very well, because you're still getting a nice valuation on it, right? So your actual investment hasn't taken a hit. So they're saying, I would like to take it out while it's still relatively high, stick it in my pocket for a hot second. And as the market adjusts, and then we can come right back into the market as soon as, we're down at the bottom. So they're moving significant amounts of money. And what these institutional, the holders of these assets are then having to say, okay, well, we've got to sell some of these. Some of our great assets, like most of them aren't holding junk. Anything, B is probably the lowest grade that they're going to get on their assets. They've got to sell some of them to actually come up with the cash to pay the investors to meet the redemption requirements. And therefore, like exactly to your point, institutional grade assets are coming into the market. And then shortly thereafter, as the market readjusts and the prices get in line, all that money is going to come flooding back in to these funds that was just pulled out. And these institutional players are going to have to say, okay, we got to go find our assets, right? We've got to go redeploy it. So you're exactly right. It's a really interesting time and it's an opportunity and it's moving assets. There's going to be assets floating through the marketplace that we haven't seen or you would never really see kind of in the open marketplace in a long time.
Correct. And we're actually seeing those assets coming online in real time. So we have arrived, as they say, winter's not coming, it's here.
Yep. And the cash, the cash requirements and what's needed is now, right? This is not we'll just float it out there and see how it goes. Like they're having to be very realistic with what people are actually willing to pay for these assets. And therefore we're resetting the value of the market, resetting cap rates, and it's happening right now. And I don't think we're done. I think office is actually going to bring us, actually pull us down even a little bit harder I was reading an article the other day and I thought this was really interesting, is that the Mortgage Bankers Association expects about 15% less in lending this coming year for commercial assets. And really that just means it's going to be harder. So even the assets that have to move, it's harder to get them. And therefore, like, the prices are going to have to keep coming down, right? Because the guy that maybe could have bought it yesterday can't get it today, right? So I think that's going to be fascinating to watch. And I appreciate you pointing that out because we haven't talked about that on the show at all.
Yeah, absolutely. I actually think this is kind of a significant point in history. It might sound a little bit silly, but it really is. I think that, when you go back and we're going to look over different points of history where real estate history specifically is very interesting. It's very interesting right now.
It is. Yes. I actually agree with you. I think that there are moments in times like with the early 90s, right? 2008, 2009 to a certain degree, because that was a forced real estate issue. But there are articles out there, if you're a nerd like me and you follow them, that like 30% plus of like the office space out there that existed, which used to be the prime investment for institutional investments, is now effectively obsolete. Like, that's a lot of space that's going to have to come online. The landscapes, the city lines, what you've seen in the past, like, that's going to change. And some of that's going to be residential. Some of it's going to be some other function like self-storage. You've seen these conversions, but there is going to be a significant shift because the value is, maybe it's land value for what 3 years ago was a fully leased up office. And now it's completely empty. And what that's going to do to the real estate market, still waiting on that. It's starting to happen, but like, we're seeing it in multifamily, and that's just the natural kind of everything flowing through the marketplace. I think we've got more to come, and I think it's exciting. And I think the world will look different in 5 to 10 years. And I think the opportunity to get in is now, right? If you wait 2 or 3 years and you're sitting on your hands, you're going to miss it, right? You're just going to be on the next wave, which won't be bad, because I think it is cyclical, but it's a good time to buy.
It really is. I agree with you. And the reality is that, you don't grow in your comfort zone. And the reality is that wealth is made with calculated risk. We don't have the assurances, obviously, of anything, but you've got to be willing to take some calculated risk. And I think that right now, that is one of the most positive aspects of the market. Despite, what seems to be very tumultuous and negative, it's really not. If you're really thinking about it carefully, this is an opportune time. It's a moment to move very strategically and make some calculated risk.
Yeah, I think that's important. One of the things too we talk about in terms of like making smart calculated risk is that you mentioned this earlier on the show, that there's deals that you're looking at today with interest rates and debt equity stacks that wouldn't pencil a couple years ago. And it's because the margins, especially on the cash flow, are very thin when you're putting these deals together, especially in a very competitive market, which we've been in for a while. So the ability to, for folks, sponsors, operators, to kind of maybe stretch out of their comfort zone in a negative way, meaning like, really don't like underwriting it this way, but hey, the market's proven us wrong. Like, I thought we needed to have exit cap rates that were higher than our entry cap rates. And, lo and behold, for the last 4 years, they just kept going down. Surprise. It's going the other way now. But what is your advice for investors? Because I think the ability to manipulate these things is very simple, right? It's, small, they're decimal point changes in a model that could make a very big difference in the outcome. So for an investor, a limited partner, a passive investor looking to put money into this opportune time, what is your advice for them so they don't get maybe taken for a ride?
Yeah, and that's a great question, and I'm glad you're asking it. What I would say, there's a handful of things that are extremely important. So, really do your due diligence on the sponsor. I can't urge that enough. Really look into their past performances, speak with some of their current investors. If they won't give you access to a few current investors of theirs to speak to, that's an immediate red flag, in my opinion. So make sure that you actually speak with some of their current investors. Don't just trust the information that's provided to you from them. Be sure to ask around, network, speak to other investors. You can easily get on Bigger Pockets or anywhere else and ask information about a sponsor. So really don't slack on the due diligence is the first thing that I think is extremely important. Second, I think this is when experience is important. Look at the team. Make sure to look at the team overall and take into account the level of experience that the team has collectively to bring to the table. That's also, I think, very important. I think that there can be, respectfully, a red flag with some that are kind of locked in thinking that they know exactly how things will go They're so experienced. They have the answers to everything, because we certainly have not been in that position in the last several years between the pandemic and where we are today. These are situations and scenarios, that no one had experience in. But you do want to make sure that you're working with a team that knows how to be agile and that knows how to adjust quickly, that is still humble, but also still has a reasonable amount of experience to make wise decisions, wise fiduciary decisions on your behalf. I think that's extremely important. So really look at the team, really look at the track record, really vet the sponsor. And then, of course, on the deal level, definitely ask a lot of questions. Really scrub those numbers. Request to see the underwriting, request to see the model. Don't be afraid to be a little bit, maybe, quote, annoying. Don't drink the Kool-Aid too much. Really vet that deal for yourself. Run that deal kind of through your own criteria and do a little bit of diligence yourself on the research of the property and the market and things along those lines. I know that it's not always a passive thing to do when you're a passive investor, but the reality is that if you do your due diligence correctly at the beginning, then the remainder of the holding period should be indeed very passive, right? So I think it's just understanding that your investments are essentially your business and you want to run it as such. Don't cut corners.
Yeah, I think it's a great point. And one thing that you said in there that I also want to highlight, which is relatively new, is being humble, right? Like when you're talking with a sponsor, they're not going to know everything. And as a matter of fact, like if you talk with somebody and they have a ready-made answer for every single question that you have, especially stuff that like nobody knows, right? If you listen enough, if you read watch the news, like, nobody knows what the Fed's going to do. Nobody knows. We expected inflation would continue to go up. Nobody expected that, the labor market would stay as strong as it was. Sometimes you just have to say, I don't know. Right? Like we are working through this opportunity. There is risk, right? Like you're trading your money for a little bit of risk with the opportunity for some reward, right? So there is risk in there. So if you've got somebody that's painting a picture that there's very little risk or there's no risk here, or they have an answer for everything, that's concerning to you, right? You do want to have somebody that knows where the fact becomes blurry, and was honest about that so that like when you're getting into this, like, hey, these are where the risks are. And if these things come up, which they will, right? It's Murphy's Law. If it can go wrong, it will go wrong. And therefore, when these things come up in the deal and you're getting investor reports, you're not going to be surprised, right? Because that's the worst thing you can be as an investor, is surprised. And you definitely don't want to be surprised with a capital call, because maybe that's the ultimate worst thing. And then maybe take it a step further is when you just lose everything. I think being humble and working with people that are people, and understanding that they're working through this as we are. They have a plan. There's an opportunity, and they're seeking to take it, and you should feel comfortable with where the opportunity is and where the risks are. So I think that was a really great call. Thank you for making it.
Thank you. Appreciate it.
Is there anything else that you feel like you'd like to convey to make this episode complete?
It might sound, maybe a little whimsical of me, but, candidly, I do think it's extremely important to remember, why are you doing any of this in the first place? And not to lose sight of those goals. There's a lot of negativity in the media, a lot of fear mongering, frankly. None of that is really positive or beneficial thinking, because all of us have goals for why we are investing. Rather it's our families, rather it's our legacy, rather it's for charitable purposes, whatever the reasons may be, that we're all out there trying to do the same thing, which is put our money to work for us and help grow that wealth. We're all doing it for something very important. And I think I think everybody needs a little bit of encouragement to remember to stick to your core and your why about what you're doing, and definitely try your best to do it. But don't let all of this, dissuade you to the point that you give up on the ultimate why.
That's right. Great point. And then maybe even to compound on your point, I like to my last question of the show is about gratitude. Nobody got to where they were without somebody giving them a leg up, or maybe an opportunity they didn't deserve. And I want to give you an opportunity to say thank you to somebody. It could be multiple somebodies that took a chance on you, gave you an opportunity. You think, you'd like to give them a little public shout out.
Well, I'm going to seem biased, but this is 100%. So I cannot be more sincere and transparent in my answer. So it really is to our CEO, Ellie Perlman. Just a very quick synopsis of how I ended up working with Ellie was, I was a single mother. My daughter got very sick, was diagnosed with some very serious autoimmune diseases. I had resigned from my job and my entire future became very uncertain with a very chronically ill kid and being a single mother. And there was a lot of unknown in front of me. And I was looking for something that I could actually do remotely from the hospital, while being there for my daughter, but also being a single mother that, candidly needs to provide for her family. Ellie, literally the second day that I was working for her, my daughter was airlifted from one hospital across the state of Texas to another. And, she, of course, asked me if I was sure I didn't want to maybe start and push my start date out, if it was always going to be like this, if I was sure that, I just maybe don't want to take the job after all. And she didn't push me out of the role. She felt, concerned for me, and she stuck with me despite the chaos of the situation all around me. Quickly, I was able to expand my standing with her in the company and be where we are today. So the fact that she took a chance on me when it seemed like a lot of odds were against me that would compromise my ability to deliver, but they did not, and that she believed in me to be able to work through those things and trusted me to do that has really revolutionized my life and where we are today. And so I think that is something that is extremely important. It's being extended not only grace, but confidence, having someone empower you despite the challenges of your circumstances and believe in you, even when the odds are stacked hard against you. So definitely, I am very grateful and candidly very dedicated to Ellie.
That's a super powerful story. As a dad that spent more nights than I care to remember in a hospital with my kids as well, being able to make it happen, like I totally appreciate where you're coming from, and you need to be there. Right. And you're in the right place and you can also deliver. So Ellie, I hope you are listening or you catch at least the tail end of this, but that's fantastic, especially early days. Like you gave Jeannette what she needed. And I think she's proven that was a great investment, but I love hearing that story. Well, I guess Jeannette, to close this off, how can my listeners reach out to you?
Feel free to email me directly. It's Jeannette, JeanneTTE at bluelake-capital.com, or feel free to go ahead and check out our website. It's bluelake-capital.com, and you can just invest with us and it'll submit a form over and get you scheduled for a call with me.
And I think one last point that I don't want to miss is you guys have an incredible podcast. So I'd love for you to share your podcast with my listeners as well.
Well, thank you, Jake. I appreciate it. Yes, we do also have a podcast, which I host, called Ready to Scale. What we try to focus on are assets, process, and strategies that are all centralized around how to scale out your portfolio, your business, things along those lines, and a little bit of diversity and knowledge, and hopefully a little bit of fun along the way too. So yes, we air every Wednesday, so you can catch us on any of the platforms that you stream your podcast on.
Awesome. Well, Jeannette, it's been great having you on the show. This has been a lot of information. It's a great time, I think, to be an investor. It's a scary time. And I think when you put those two things together, amazing things can happen. So thank you for being here.
Thank you, Jake. I appreciate it. It's an honor.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.